Hi, I'm Peter Rose, founder of Longwood Currency Trading. Three rules to judge the strength of your entry possible position getting into a trade. That's the topic that I want to cover today. But before I get into that, I wanted to talk in general a little bit about the trade entry itself as a piece of a puzzle that I call the life cycle of a currency position. It's solving any kind of problem, and I know this based on my 33-year career as a software engineer. You take a complex problem, you break it up into a bunch of pieces, you solve the piece, you move on, solve the next piece, hook the two together, make sure that the order of the solutions are correct, and that's how you move forward. So in the software transition into trading, I have what's called a software development life cycle mapped to the life cycle of a currency position, which is entry analysis, position management, and exit methodology. If you watched any of my videos, then I've said that a gazillion times. And you'll note that a lot of the videos that I do center around that entry process. Because if you don't get your entry right, you don't have a position to manage. You're not going to make any money. So when we're looking at solving the problem of trading, if you can't figure out the entry analysis part, you're not gonna be able to do anything. It's like a swimmer who's going to compete in a crawl or something in a pool. If they don't know how to get set up on the stand, ready to push out and get into the pool, that's going to slow them down tremendously in relationship to those who do know how to do that. The race is won by that start. Who can make that start work the best? So we're going to get into that. I'll get onto the whiteboard in a minute here. Actually, let's walk on in there and do that. It's a beautiful, if you can't see, it's a beautiful summer day. Actually, the end of summer for us. This is Labor Day in the United States of 2023 in September, early September. Everybody has a day off, and there'll be parties and stuff. And I had my party yesterday. Sue and I kayaked earlier in the week, and then partied on through. And so today we have the day off, and she's off walking the bow dog in the woods somewhere. So let's get onto the whiteboard and see what this is all about. So look, just to keep it simple, 3 rules to judge Forex trade entry strength. 3 things. You got to look at the price direction bias that price has. You consider about the order flow congestion areas, which could create zones of heavy buy or heavy sell activity that could disrupt price action. And number 3, you look at the current price range, the candle size, as the versus the current ATR of the position that you're looking at. All right, so here we go. Here's price, and again, I don't show price on charts or with candles and all that other sort of stuff, because that's not what I'm discussing, and I don't want folks looking on charts to try to duplicate exactly what they see. It's the principles that we need to consider. So here's the current price where the little dot is. Number 1, price direction bias. What do we need to know about that? Well, we need to know that price is moving in that direction, so that, you know, if you have a car that's rolling downhill, it's probably going to continue to roll downhill because it has that momentum behind it. And so that's what we consider price to do the same thing. We just look at nature around us and see what works in nature, and that's what's going to work in everything. That's my physics background. So the price direction bias is up. We're going to say that it's up. Isn't that a lovely arrow? How do we determine that? Well, you look at the chart. That's trading. When you're learning, there's certain other metrics and things that you have to bring into play to determine the consistency of that move, the repeatability of that move, all that other sort of stuff. And that's part of what you would learn if you took a course or somebody was to lean over your shoulder and work with you as you were learning your trading. But I'm just defining the rules. I'm naming the rules, and then based on the time frame that you're trading on, what kind of trader you are you a day trader, a long-term, long-haul trader, scalper, whatever, you need to figure out the specific content of the rule to make this all make sense for you. I'm a day trader. I'm on a major pair with on a 5-minute chart with an ATR of 5. So that's where all my stuff comes from, because if you can learn that, the day trading structure, you can migrate all that stuff up into the swing or the long position trader stuff. But if you're a long-term position trader, none of the stuff I'm talking about is going to make any sense to you, and you're going to say, oh, it's too much noise down on those shorter time frames. In any event, that's the situation that I speak from. You do whatever you need to do, but if you understand what I'm talking about, you'll be able to map that up into whatever else it is that you're doing. Price direction bias. You just have to have some key to say it's moving up. In this case, right, we're going to continue with the price up. So this is number one. Number two, there's no order flow congestion. Well, let's get rid of this. We're looking at where's our profit target supposed to be? Well, let's say this is 25 pips. And that's our profit target. That's where we're trying to get to. And so if there's something in the way here, for example, this thing could be some order flow congestion in this zone. And we are actually in that zone right now. So the implication here is if we can poke above that zone, then our area is clear up to probably this point. We've got a profit target here, which is below that. So are there any order flow? Is there any order flow congestion between where you're considering entering and where your profit target is? Now, in other videos that I've done, I've also talked about the opposite of the profit target congestion order flow, but also the exit part of the methodology, which has to do with congestion in your stop area, stop loss area. But I'm not going to cover that today because it's the generic thing is no order flow congestion in your entry. And we'll just make the simple case of the position of toward the profit target. And so this is number two. Number one and number two. Number three, the current price range versus the ATR. Well, we don't really have very much of a candle structure here. But if you have a candle like this, so you get this, and then your next candle is this big, and your next candle is this big. This would probably be, let's say that's a 5 ATR. That candle matches the 5-period ATR. This candle here, let's say that's a 7 or an 8. And let's say this candle here is a 10. So that you see that the candle size is changing and increasing in respect to this 5-period ATR. One's a 7-8, then they go to a 10. You can drop back to a 6-8. It's just that there's something going on that's causing the candle size to grow. What is that? Well, it's supply and demand. And so if you can see that the current price range of your candles is changing in relationship to the overall ATR, then that's going to draw some attention to you. If you're looking at an entry, for example, and you have this going long, then you'd say, well, you know, this is probably going to satisfy if the candles have been like this, going the wrong direction here, Bob. I've had 5-period candles, and now now I'm looking at this, and we're in here somewhere. You're seeing that this candle size is increasing over the ATR, so this is your number 3 scenario that we're dealing with. And I did a similar video to this, a little bit more detailed, because I was kind of showing how you build rules. These are the rules that you would look at for your generic entry, and you would say, if these 3 conditions are met, then I might have an entry. Now there's other things that you consider, probably 6 or 8 different things as you're learning that you would need to have on your checklist, and when you become experienced, there's only like 3. But the generic considerations to determine whether this price has any chance of moving this 25 pips to your profit target is, do I have a confirmed or reasonably, from a probabilistic standpoint, opportunity that price direction bias will continue long enough to fulfill that? Number 2, do I have anything in the way of that? You know, if I'm driving my car down this road, are there any trees that have fallen, or are there any potholes, or is there anything in the way that could hamper me? And so you have to look for that. And then third, what I refer to as a physicist and a mathematician is momentum. I'm looking at price as a momentum, and I describe what that's all about in consulting and coursework that I do. But regardless, to say, you don't have to know anything about momentum. You just have to say, well, it's moving, and it's moving proportionally more than the average over the ATR period. And the standard ATR period, of course, is 14 periods. And so as this begins to change in real time right away, then eventually the ATR will begin to change and catch up with it. So the trick is in catching it just as it begins to change, and not later when the ATR begins to morph more toward what the normal candle size is. And that's why you can go into some multiple time frame analysis, and you can look at maybe the 5-second or the 1-minute chart, because you'll catch those momentum changes earlier. I mean, if you're looking at the 1-minute chart, you're going to catch those. You're going to catch those changes 2 or 3 minutes before that, and act on it. Whereas if you're looking at the 5 or the 15-minute candle, it could be 15 minutes before you go, oh wow, I've got this differential. But by that time, it might be over. Remember, if I'm doing 5 candles and I'm going 25 pips, I've got 5 candles. That's where I've got to make my decision. So I've got to. This is already have to be happening before here, because I can't wait 5 candles to say, oh, I've got the momentum, because I'll already be at the profit target. Okay, so that's the basic layout of the thing. All right, time for coffee, and time for you to maybe sit down with a piece of paper and try to recreate what I just did on the whiteboard, and see if those 3 rules don't make sense to you, and how you would apply them to whatever time frame it is that you're conversant with and trading on, whether that's an hour or a daily chart or whatever it is that you're doing, and see if you can figure out some rules that would be proportional to what I just described on the 5-minute chart with a 5-period ATR. Peter Rose, Longwood Currency Trading. Have a great day, and have a great trading day.